Welcome to Honey Explains Money, your guide to financial clarity, where money stops being confusing and starts making sense for everyone. Let's begin this journey together right now.
Welcome to The Explainer. So today we're unpacking one of the most fascinating and honestly dangerous paradoxes in all of finance. We're looking at this deeply ingrained assumption that most of us carry around, the idea that working harder, putting in way more hours, and actively grinding is naturally going to yield better financial results. I mean, it makes sense in almost every other area of life, right? But as you'll see, the stock market plays by completely different rules. Let me just pose this question directly to you right off the bat. Does working harder in the stock market actually make you richer? You know, we're constantly bombarded by the flashy illusion of active trading on social media. The screenshots, the 3-monitor setups, the sheer action of it all. It makes it look like the absolute only way to build real wealth. But today, we're going to look right past all that hype and let the real, undeniable math do the talking.
Okay, let's dive into this by running a little experiment, a perfectly fair race. We've got 3 investors, Tyler, Greg, and Ryan. Now, they're all exactly 30 years old, they live in the same city, earn the exact same salary of $75,000 a year, and they sit in the exact same tax bracket. They even share the exact same goal, which is to retire comfortably at 60. And most importantly, they're each putting exactly $1,000 a month into a regular brokerage account for 30 years. Same exact money in. The only difference here is their strategy. Tyler's our day trader, hunting daily moves. Greg is our swing trader, holding for a few days or weeks. And Ryan, he's our index investor. He just buys the whole market once a month and does absolutely nothing else.
Now, for the first couple of years, Tyler looks like an absolute genius. He's at his screens before the opening bell, he's studying candlestick patterns, making hundreds of trades a year, and when he hits a hot streak, he's screenshotting his best days and blasting them to the group chat. He really feels like he has an edge, you know? He's actually out there doing something while his friends just sit around. Those early wins feel like undeniable proof that his strategy is working. But, well, here's the problem. Feelings and math are two very different things. Tyler's frantic daily trading creates this mirage of success that completely masks what's actually happening under the hood of his portfolio. And here's the brutal reality behind that mirage. There are 3 invisible forces quietly evaporating wealth from active accounts. Wall Street has understood this math for decades, even if Tyler's trading app conveniently forgets to mention it to him. These 3 leaks, taxes, friction, and overconfidence are actively working against him every single time he clicks buy or sell.
Let's break down that first leak, which is just an absolute wrecking ball for day traders: short-term taxes. Because Tyler holds his investments for less than a year, actually, he buys and sells on the exact same day, every single winning trade triggers a short-term capital gain. This means his profits aren't getting taxed at the lower long-term rates. No, they're taxed as ordinary income, right alongside his regular paycheck. For someone making $75K a year, that's a 22% tax rate at the federal level alone. Tyler is literally handing roughly a fifth of every single winning trade straight back to the IRS in the exact same year he makes it, which completely destroys that money's ability to compound over the next 3 decades.
Then we have the leak Tyler never even feels: friction. Every single trade carries a microscopic cost. It's the spread between the buy and sell price, maybe an occasional fee, or slippage when a price moves just a hair before its order fills. On one trade, sure, it's just pennies. But Tyler turns his entire account over easily 20 times its value in a single year. Even at just 0.1% per round trip, turning his account over that much means roughly 2% of his money quietly vanishes into thin air every single year before he's made a single dollar of profit.
And then we've got to confront the statistical reality, which is heavily driven by overconfidence. The data on this is just brutal. A landmark study actually showed that most active traders underperform the market by about 6.5 percentage points every year. People systematically sell their winners way too early and hold on to their losers way too long. A few good, lucky trades end up wearing the expensive costume of skill. But look, just to make this completely fair, we are going to be incredibly generous for our experiment. We're going to assume Tyler is in that top tier, better than 80% of day traders, and he actually consistently makes money on his trades. Keep that in mind, because even giving him this massive advantage, the math is still hunting him.
Now let's take a look at Greg. Greg sees Tyler's frantic lifestyle and decides to play it a bit calmer. He's a swing trader, holding for weeks at a time. And because he trades far less, his friction costs are genuinely lower. But here's the catch. The 2 biggest problems don't vanish, they just shrink a little. Greg is still holding positions for less than a year, which means almost every single gain he takes gets hit by that exact same 22% short-term tax wrecking ball. Plus, he's still trying to time the market, guessing when to jump in and out. So Greg bleeds less money than Tyler, but make no mistake, he is still bleeding.
So why does Ryan, the guy doing literally almost nothing, have such a massive advantage? Well, Ryan buys one low-cost S&P 500 index fund every single month. He basically buys the entire U.S. stock market, and then he just closes the app. He wins on taxes because he never sells, meaning his money compounds completely untouched by the IRS for 30 years. He wins on costs because there are practically zero fees, no spreads, and no slippage, and he wins on control because he alone decides when a taxable event happens. Ryan's strategy is incredibly boring and absolutely incredibly effective.
So, the crucial point all comes down to this. We have the frantic day trader, the calmer swing trader, and the completely passive index investor. They all put in the exact same $1,000 a month. Fast forward 30 years to retirement, who do you think actually retires rich? I promise you the gap between these three isn't just large, it's totally mind-blowing. Let's watch how this actually builds over the years. Now, for the first few years, it honestly looks pretty close. By year 5, Ryan's at $75,000 and Tyler's right behind at $63,000. Tyler still has the best group chat story, so, it feels like a tie. But by year 10, the lines start to separate. Tyler's at $134,000 and Ryan pulls ahead to $192,000. By year 15, the gap just explodes. And by year 25, the gap becomes downright cruel. Ryan is sitting on nearly $1.1 million, while Tyler, who has been working at this every single day, has just crossed $400,000. And there are still 5 whole years left for compounding to do its most violent work.
Fast forward to the grand reveal at year 30. Remember, they all invested the exact same $360,000 out of pocket. Tyler, our hard-working day trader, lands at roughly $511,000. Greg, the swing trader, finishes around $812,000. But Ryan, the guy who bought one index fund and closed the app, he retires with $1.77 million. Ryan ends up with over 3 times the wealth of Tyler. That's over $1 million more. And remember, this is the generous version where Tyler actually made money on his trades. Tyler didn't lose because he was dumb. He lost because the math of taxes, friction, and market statistics ran against him every single day.
Now that financial gap is staggering. But I need to drop this massive number on you right now because there is one final irreplaceable cost in Tyler's strategy that we haven't even added up yet. $60,000.
Let's look at the time spent to deliver a real gut punch of a realization here. Tyler watched the market, did his morning prep and evening reviews for about 2,000 hours a year. Over 30 years, that's 60,000 hours. That is the equivalent of working an entire second full-time career. Greg spent about 10,000 hours, and Ryan, taking a few minutes a month adds up to roughly 120 hours, or about 3 total working weeks over his entire life. Think about that. The man who sacrificed a 60,000-hour second career finished last, over $1 million behind the guy who spent 3 total weeks managing his money. Tyler literally paid 60,000 hours of his one life for the privilege of losing money.
So, what's the actionable playbook here? How do we actually build wealth without falling right into that trap? Step 1. Build your core wealth in low-cost index funds. This is your boring, reliable engine where almost all your money belongs. Step 2. Look, if you genuinely have the urge to trade, and hey, that need for control is a real, totally normal human feeling, just wall it off. Take no more than 5% of your portfolio and treat it like a casino. But crucially, do it inside a Roth IRA so that your short-term gains aren't taxed, completely stopping that massive leak. Step 3. Be honest about the scoreboard. Always measure your trading returns against what the simple index did over that exact same period.
I really want you to take a second and absorb this quote from our source material today. The trap was never trading itself. The trap is mistaking activity for progress. Tyler felt like he was winning every week just because he was busy, but the stock market does not pay you for effort, and it certainly doesn't pay you for stress. For the vast majority of people, the stock market only pays you for patience.
Now, all 3 of the guys we looked at today spread their money across the whole market, or, at least tried to, but it leaves us with an incredibly fascinating question. What if one of them had skipped the trading, skipped the index entirely, bought a single great company 30 years ago in 1995, and simply forgot about it for 3 decades? The math on that might be the most surprising of all, and it's exactly the kind of deep dive we love doing here. But that's a story for our next explainer. Thanks so much for joining me today, and keep learning.
Thanks for watching Honey Explains Money. Subscribe for more powerful insights on wealth and finance. See you in the next video.